Good morning and welcome, Patriot Radio News Hour. Joe and Jason. Well, Jason will be here momentarily. Welcome to Thursday, 800-951-0592. That is our toll-free number, as if you didn't know, the physical delivery of wealth insurance. And, you know, they promised us they fixed it. They said that too big to fail was no longer going to be a problem. And I guess they were right, because it's not the too big to fail banks that are screwing it all up. It's all the other banks now that apparently have the problem. allamericangold.com is the website. And once again, you know, it's kind of, who is it today that's having the problems? Yesterday, Credit Suisse, we talked all about that. They got a bailout. Yep, the Swiss National Bank got a bailout, gave Credit Suisse, you know, just a couple of dollars. You know, don't panic. $54 billion, just to start, just to start it off, just a little, little seed money. They're probably going to have to get more than that. But First Republic, we've talked a lot about them. They're down heavy again today. And Jason, I don't know that I get a feeling. I don't know anything. I'm speculating here, but as it sits right now, I wouldn't be surprised if First Republic gets taken over by the FTC this weekend.
Yeah, we were talking a little bit before the show about that. I just, the stock is hanging down there in low territory. And I was wondering, well, who would buy such a thing? And there's always somebody that speculates. Obviously, there's somebody, but if you can't fix the deposit situation at a bank, it's kind of incurable. So we'll see if Superman comes in with his magic money cape and fills his bank full of money, and then suddenly it was, oh boy, I bought the stock at 10% of what it was a couple weeks ago. But we'll see, because obviously the Fed's picking winners and losers, aren't they?
Well, yeah, and I don't know if picking may be the right word, but yeah, they buy their policies. There's no doubt, right? There's no doubt. Hey, we decided to have zero interest rates for 15 years. We told, matter of fact, they set up the rules. The rules are pretty simple. Hey, you've got to buy these certain securities. Well, what securities? Well, you got to buy treasuries, and you got to buy real estate securities, mortgage-backed securities. Those are the two primary securities that these banks need to hold. Well, fast forward now, and when you get these little bank runs, and we've talked a lot about it, the banks don't have all this money, right? When you sit there, you're putting your money in the bank. You don't own the money. The bank owns the money. And really, it was brought out this weekend. You kind of learned that lesson, didn't you? Well, you know what? We're going to guarantee it, even though that's not the rule. We're going to guarantee it anyway, just for these two banks, because you don't actually own it. I mean, that's just the realities of it all. But the interesting part in all of this is, if you have especially a small concentrated group of large depositors, those banks are at risk, because unfortunately, they call them unrealized losses. If you go out to the website, allamericangold.com, go down towards the bottom, Jeff Gunlach. It's a great interview. And here's what the central bank is trying to do right now. Trying to make this problem go away, and it's not going away. They're saying to these banks, hey, you can come to the Fed window, and we'll give you 100% value. Here's the problem. What they're giving the Fed, it's worth 60 cents on the dollar, 70 cents on the dollar. And the central bank is giving them 100 cents on the dollar. And again, the Fed has no money. They only create it out of thin air. Jason, if people actually knew what they were doing to try to keep this thing going, even it would actually make the problem worse because people will be like, okay, wait a minute, that's a huge problem. Because again, there's no way for these banks to pay it back. And why would the bank even be interested in paying it back if they're like, well, wait a minute, I sold it to you at a 40% loss, right? Why would I want to do that?
Well, for the Fed, it's a good deal because you offer nothing to save them for a year, so to speak, and then when they fail, you get all their assets for free. You know, this is how it works. That's the peanut butter jar, Joe. All these businesses and people, the peanut butter is taken out of the jar before the crash. All the big money's already out, and all that stuff that's stuck to the side. That's what everybody's been building for years and years, and then here comes the big old spatula, just cleans it right out. That's a very good example of that. I think some of these small banks next year, boy, what's going to happen next year, Joe, when they can't pay back?
Yeah, it's going to be. It really is. It's interesting to see how all of this is going to end up. Even in Europe, the move to save Credit Suisse. Unfortunately, the shares which rallied, over 20%, are starting to give back those gains. And those credit default swaps that we talked about, Jason, they barely moved. They're still way out of the money here. And I think that's because I think most people realize that's not enough money. Right? They're going to need a whole lot more than that to fix the problem. Matter of fact, there's talk that it will have to come from the ECB. That Switzerland doesn't have enough money to help them anyway. I know, isn't it nuts? Patriot Radio News Hour. How much does your portfolio weigh? We'll be back after the break. (800-951-0592). A quick little market recap, and I've got news breaking we'll get to in just a minute. The Dow is up, and this is all just in the last 10 minutes here, up about 60 points. The S&P's up 20. The NASDAQ's up 100. Gold is down. Well, it depends on where you look. I'm going to say gold's down. I think Kitco's got it up. Doesn't really matter. $1,926 on gold. Silver, I've got it down 17 cents in New York, $21.60. The turnaround is there is a story out in the Wall Street Journal that they may be able, to sell First Republic here. They're saying that JP Morgan and Morgan Stanley are in talks here. Again, though, these are the same banks that they tried to get these banks to buy Signature Bank. They tried on Sunday to get them to buy Silicon Valley Bank. But right now, this is a story that is circulating that there are several large banks are discussing a deal with First Republic that could include a sizable capital infusion. Obviously, this would be a major blessing. I'll say this. I don't believe that unless, Jason, they're given some incentive, right? There's got to be, unless they've given them some incentive. Listen, there's no reason to help this bank that is sitting on losses of, as Jeff Gunlot said, listen, the best case scenario is like 20% losses, 30%, 40% losses. But nonetheless, this is what has broken in about the last 10 minutes. I mean, gold was up and up pretty big here, off a little bit on this news. And again, Wall Street was down as well. But right now, anyway, First Republic's options have narrowed significantly. They're saying that deposit outflows and sharp price in their stock. So, Jason, either they get this deal done or this is a bank that won't be here come Monday. That's what it looks like anyway.
Yeah. And this is why earlier in the week I had mentioned that I think that I think the Fed and the powers that be are going to figure out how to try to quell this current situation. And then the markets will go back to being ignorant to the whole thing. But because these first few banks closed last week, Joe, to go to flush out some of these bad assets in a bankruptcy or whatever the situation is for these banks are getting rid of, the people that had their money in there, it may take 60 to 90 days to figure out who really the losers are, if there are any. And because this has a ripple effect on other banks and other institutions, all this movement of money is probably upsetting the apple cart pretty bad. And so this past week is a huge indication of it's going to happen now. This big step down in banking and in the markets with the inflation and the problems. It's happening now. But is it going to get serious right now this month, like super serious, or is it going to get super serious in 60 to 90 days? How fast will it move? I just don't think it's going to move as fast as it did in 2008, Joe. I mean, things for a while there in 2008, things were moving so fast, right? I mean, every single week for like a year or 2 years, it's like there's always an emergency. I don't know if it's going to move that quickly at this point in time, or if we got a little bit of time to wait. It's why it's a great time to buy gold at the prices they're at now, because when this thing gets moving, gold will react, and it'll react in a very high upward trend, especially since, unlike 2008, this inflation is much more severe.
And it's interesting, really, really is interesting. They don't want us to know what the price of these securities are, right? I mean, this isn't the whole point, right? What is Wall Street really? Really, it's supposed to be price discovery for debt, right? How much is a company's debt worth, right? How much is these mortgage-backed securities worth? What's a bond worth, right? It's a price discovery mechanism. And what they're trying to do is hide what the value of these securities are. Why do you think the Federal Reserve said, you know what, we're just going to pay a full price?
Right.
Why would you do that? Matter of fact, because the rules are, hey, whatever the price is, whether it could be full price, heck, it could be 110%. You got appreciation. Hey, it's worth 120%, or it's worth 90% or 95%. And then the Fed is supposed to, if a bank needs to go to the Fed window, because, hey, you know what? I'm short a little bit here. I need a little help, just a day or two. I'm going to go to the Fed window. And the Fed's supposed to take a number below that. Let's just say that it was at 95%. Okay. 95% of it. The Fed's supposed to say, hey, we're going to give you 94% or 93%, right? We're gonna give ourselves a little bit here, right? We're not going to, just deliberately lose money. But they're so fearful because let me give you the simple truth. The simple truth is, if we had true price discovery, everybody out there would be like, man, these banks do not look safe. Right? We'll put the too big to fail banks in one category, because as we know, they promised us we've set it up. They're not going to be systemic risk and they can go out of business. No, they can't. I mean, if you want Wall Street to be 5,000 points tomorrow, then let one of them go out of business, right? Not going to happen. But all of these other banks now, Jason, are essentially insolvent if people pull their money. It's just that simple.
It's like a bad fashion trend, these assets, right, Joe? That are unsellable. It's like, let's just take the 70s. There was inflation in the 70s. It's like bell bottoms. Suddenly somebody looked down and was like, I'm wearing ugly pants, and everybody stopped wearing them, right? Somebody figured out that the fashion trend was no good. And then suddenly everyone ran away from it. They don't want that to happen right now. They don't want people to look down and find out they're wearing bell bottoms. That's what's happening. It's a good observation, because if you're a bank that's in trouble and you can't sell your assets for the full price, everybody else is going to look around and like, wait a minute, we're holding the same thing. And if the Fed isn't going to buy it from them, they're not going to buy it from us. That's exactly what's happening.
And the funny part is some of these banks are bad banks. Okay, there's no doubt about that. But by and large, the banks probably didn't do a lot of things wrong. hey, you told us we had to buy these things. That's the rule. But of course, we need them to buy these things. Could you imagine if banks weren't buying treasuries, how bad it would be? I mean, it'd be terrible, right? They got to buy them. But now, think about this. It's one thing, we talk about these bigger companies, these bigger depositors pulling their money. There's another side to this. There's another side. This is why I think they're trying to stop this crisis, which is, hey, we need all you big depositors to stay put, right? That's what they're trying to do, right? To stop pulling your money out. Now, all of a sudden, and we're talking about some of these bigger banks that most people haven't heard of, right? Now we're talking about banks people have, Zion Bank, Comerica, PacWest. These banks are starting to get bigger, right? We haven't talked about the little banks. Goldman Sachs out with a warning this morning that, hey, guess what? We're tracking all the small banks because we might start having a problem there as well. But here's the other side of it. Like I said, they're just trying to stop people from pulling their money. But this is going to most likely is going to contribute to a slowdown in the markets. And again, I'll quote Jeff Gundlach. He was talking about bond yields. The yield curve has inverted, right? The 2-year note was a whole point above a 10-year note. But what I didn't know, which to me is, hey, a recession's coming in the next 6 months, 6 to 12 months. Jeff Gundlach in his interview was saying, hey, when the yield inversion starts to shrink, that's when the recession is right around the corner. And guess what? Since Friday, this yield curve inversion has shrunk. Now the 2-year note is yielding only half of a point more than a 10-year note. And Jason, what I'm getting at is the next wave of this crisis may not be that people are pulling their deposits. It's going to be the remaining big depositors up the economy soften. Hey, you know what? We're gonna be losing money for a little while. We got money, but we're gonna all of a sudden, hey, instead of having 10 billion in their bank account, it's 9 billion, it's 8 billion, right? It's 6 billion. And all of a sudden, we've got the problem all over again. But it's not that people pulled the deposits. It's simply that what? The amount of deposits shrunk because they started taking losses.
Yeah, that's right. I was looking at some videos last week and talking about this. This may not be a housing mortgage crisis. It may be a commercial property crisis coupled with a depositor crisis. A bank. It's another banking crisis, Joe. Which you were saying, I think it was yesterday, 2 days ago. It's like, I can't believe it's another banking crisis. Why? It should have been something else, right? But right. This is just showing that they never fixed it in 2008, 2009, 2010. They just didn't fix it.
Yeah, Barron's is saying they're out. They said that Morgan Stanley has declined to comment. JP Morgan did not respond for a request about are they actually in talks with First Republic. Barron's went on to say that First Republic, there's trouble. They're saying that without this, that it doesn't look good for the bank. So we'll have to wait and see. Again, the news of the day, if you will, broke about, 5 minutes or so before we got on the air that maybe First Republic was going to get an infusion of cash, and Morgan Stanley and JP Morgan were mentioned. And Jason, again, I don't know that this is going to happen with due diligence. Or they would have to get some kind of reward. I just don't know what that would be.
No, it'll be wait and see, right? I think this next couple of days and the weekend is going to show us a lot as to how this first stage of bank failure is going to be treated. They're already kind of messing around a little bit, Joe, but what are they actually going to do especially through next
It's
week.
going to be
You know,
interesting. Let's just say that let's take this story at face value, right? That they're looking at it. If they don't do it, let's just say they're like, nah, we're not doing it. Remember last week, the federal or the FDIC said, hey, we're going to guarantee all the deposits. Are they going to do that again here with First Republic? Logic says they would have to, right? Hey, you got to do that. And then all of a sudden, right? Well, how much money is that going to leave actually in the FDIC? Rumors today, they're still trying to sell the two banks, Signature Bank and Silicon Valley Bank, Jason, right now. One of the things is the FDIC, listen to this, the FDIC said anybody that wants to buy Signature Bank, you must not be involved in crypto at all. That is one of their rules to getting this bank sold, which is kind of funny because they're kind of known as the big crypto bank. And now they're saying, well, if you want to buy it, you can't be involved in it. But already, it's already Thursday. And they still don't have buyers for those two banks. And now essentially we got to add this bank here. This bank needs a buyer.
Needs a buyer. And how many more are going to need buyers, Joe?
800-951-0592. Patriot Radio News Hour. Joe and Jason will be right back.